What are your financing options when you're looking to buy a home? Well, really, that depends on exactly what you're trying to do. Okay, are you trying to buy a home to live in as a primary residence? Are you trying to buy a home to rent out? Are you an investor looking to come up with creative financing, these sorts of things? So it all depends on exactly what you're trying to do. And you could even include, are you trying to purchase an Airbnb into this? They're all a little bit different. I'm going to go over all of them really quick. Okay. So as a primary residence, okay, you can have you're just going to get a 30-year amortized fixed rate mortgage, or you might get a 15-year fixed rate mortgage, depending on your age and how quickly you would like to pay off that mortgage. But those are going to be your two typical type of loans, okay? You're really not going to want to go in and try to get some adjustable rate mortgage or something to that effect. And if that's offered to you, it's probably better that you find a different person to talk to in regards to lending, because that kind of program is can be very misleading to buyers, and it oftentimes ends up with a financial problem once they start raising interest rates and stuff like that. So you're going to go in and you're going to get a first time home buyer's loan, a conventional mortgage, a VA mortgage if you're a vet, and they're going to give you a 30-year fixed rate loan. Okay. The only things that will change within these loans is the interest rate and how much money you're going to be paying out of pocket when it comes to closing. Okay. So as a and thirdly, you can get a conventional mortgage if you have a sizable amount of money to put down as a down payment. You could get a conventional mortgage, but those are going to be, as a primary residence, what you're going to be using for a mortgage, okay, or a loan type. Now, if you're buying something as an investor, okay, let's say that you want to buy a secondary home. Okay, let's say that you want to buy something that you can rent out, or that you can come to Florida and just stay in for a little while and go back home, these sorts of things. You're only going to really have two different types of loans. And the first one's going to be a conventional mortgage, which you can also buy a primary residence with. All a conventional mortgage is a higher down payment 30-year mortgage. That's all it really is. So you can do this, and they write conventional mortgages for that very reason. You have more money to put down, which is less risk for a lender, and at that point they'll take on the value, right? So typically you're going to put down 20%. Sometimes you can get them for 10 or 15%, but let's just stick with it. It's going to be probably a 20% down payment. Now, this is a great loan because it overlooks a lot of stuff that might be wrong with the house. So if you were going to if there's some upgrades you want to do, this sort of thing, you can use this loan for that exact purpose. Okay. Now, the other kind of loan you can get if you're looking to specifically rent the property out, let's say you want to put tenants in there immediately, is what's called a DPMS loan. Okay. This loan is structured to where you can go in and you're basically providing a lender with the rent. And you're saying, hey, this property will rent out for $2,000 per month. And they structure the mortgage based on that rent amount. And they give you the mortgage as an investment, okay, based on the rent. Okay, now they do their own research and these sorts of things to justify if the rent value that you're providing them is accurate based on what they see. But that's the overall structure of the mortgage. It's a mortgage that you provide, is provided to you so that you can put a tenant in there. It's a very good program. And a lot of them that look at stuff like income based, they just look at your income and they provide you with the mortgage. They look at some of them look at only what the rent is and your credit score, and they provide you with a mortgage. So it's a very strong and powerful program if you're trying to dive into the rental market and buy a rental home. This is a very good program to utilize. Now, those you can get those with a 15% down payment, but typically it's probably going to be closer to 20 or more. But if you have a high enough credit score, I've heard of lenders giving them at 15% down payment. So that's that. Now, if you're doing an Airbnb, you can get a loan that's structured for an Airbnb, okay, based on the income that you can provide to them. So if you can show income on a property through an Airbnb, then a lender can give you a loan based on that income levels. The problem is with that loan, and I don't ever recommend this loan, is if you don't have a successful month or several months in a row, then you leverage more money than what the property can actually rent for if you have to default to a yearly rental. Okay, that's the danger of this program. You can Google this. You'll see a lot of horror stories where this sort of thing this sort of thing will come around. That somebody got a loan structure based on the Airbnb rent they had, and then the market kind of softened up. They're no longer pulling in that revenue from Airbnb, and goodbye properties. They end up in foreclosure because they can no longer cover the rent. They no longer can cover the mortgage with just a regular rental structure. So if you're going to go down that route, I'd advise being super careful about that. And then the final way of buying things is creative financing. Okay, this is a very powerful way to do real estate, but it is an advanced form of lending. And this is where you maybe are the buyer, or you might even be the seller, and you do what's called owner financing is one option, where the owner actually holds the note, and you either look for someone who's willing to put a sizable down payment down, and you hold the mortgage for them, or or as a buyer, you're looking for somebody who's holding a note for you, and you are in fact paying them the balance of what the mortgage will be. That can go either way. I mean, a lot of times there's some negatives and positives to that. I don't want to dive too deep into the weeds on that, but there is, you want to research it before you would ever pull the trigger on something like that. All right, there's also lease options to own, where you're a landlord and you offer that to a tenant. Hey, you can rent this out for a few years. You have the option to buy it. Okay, as a tenant, you can look around and say, I want to find something where I can have the option to purchase it, and you can actually ask a landlord, hey, can I buy this property from you in a few years if everything in the situation works out? And they can put in the contract, you have a lease with the option to buy on X date for X amount. That's something that people utilize. There's all other sorts of creative financing that revolve around these two strategies, and there's all kinds of ways to write up contracts where you can have note holders and all kinds of different ways to do things. But mostly, if you're going to get into creative financing, you're going to be something that is circling around what would be an owner financing or a lease option contract, something to that effect. It might be a little different. They might call it something different, but for the most part, it's going to fall into those two categories one way or another. So that's really the gist of it. When you're looking to buy a house, you got to decide, number one, how long do I want the mortgage to be? 30 years or 15 years? Number two, is this my first house, or is this a secondary home, or is this going to be a rental? And then finally, am I, or do I need somehow to do creative financing because of my credit score, or because I'm interested in trying to find a buyer who's willing to do this? So those are the ways that you can get a loan.